Richard S. Lehman has over 35 years of practicing tax law in the United States. Mr. Lehman has had extensive experience with all areas of the Internal Revenue Code that apply to American taxpayers and non-resident aliens and foreign corporations investing or conducting business in the United States, as well as U.S. citizens and domestic corporations investing abroad. Richard has a national reputation for handling the toughest tax cases, structuring the most sophisticated income tax and estate tax plans, and defending clients before the Internal Revenue Service. Richard Lehman began his career in tax law with a law degree from Georgetown University, a master's degree in tax law from New York University, and 2 years of clerking for the Honorable William M. Fay, a judge on the United States Tax Court in Washington, D.C. He spent several years as the senior attorney of the interpretive division of the Chief Counsel's Office at the Internal Revenue Service, the IRS's internal law firm. Today, Richard works with other lawyers, accountants, business leaders, and individuals who are struggling to find their way through the complexities of United States tax law.
What we're going to talk about today are what has happened recently. Everyone who's involved in this will wake up to this with the April 15th filing in the year 2012 of their year 2011 tax return. The first law that was passed is called the Foreign Account Compliance Act. That's a law basically requiring that U.S. taxpayers disclose all kinds of foreign assets that go way beyond the old rules where what was reported was only foreign bank deposits. We're going to spend some time with that new law. We're also going to spend some time with an amnesty that the IRS has come out with. It's not the first time they've done this, but it's a new amnesty to allow people who have issues with foreign disclosure, where they haven't made disclosures of assets and taxes are owed, to come forth and at least avoid any criminal penalties. Third item, which we're going to discuss, is, as a practical matter, now a concern starting in the year 2013. There is going to be a requirement that all foreign financial institutions report all American accounts of any kind whatsoever that they have, and the income from those accounts, and the value of those accounts as of 12/31/2013. In addition to the foreign financial institutions that are going to have to make those reports, certain foreign companies that are not financial companies are also, if they have substantial U.S. owners, are going to have to make those reports on their substantial U.S. shareholders. This is a very new twist. This is worldwide reporting on Americans by foreign institutions and foreign companies. Now, as of late July, there even became another refinement of this, which we're going to discuss in more detail. But this reporting requirement is now going to be reciprocal, and countries are going to report to the United States on U.S. investors in those countries, and American banks are going to be forced to report to the investors from those foreign countries that have bank deposits and all other types of deposits in the United States to those countries, to their home countries. It's an interesting development, and we'll cover it in some depth. What I'd like to do right now, also by way of continued introduction to these three different subjects that we're going to deal with, is we need to walk very carefully down a new chart that I have drawn here. This chart shows you as a practical matter just where America is going. There is soon going to be built a database held at the Internal Revenue Service and in the Treasury Department that is going to know every United States taxpayer's source of income from all over the world, United States and any other place outside of the United States. And for the most part, every United States taxpayer's net wealth. When I say that, that's United States taxpayer is any kind of person or entity that's going to file a United States return. And that's what the chart shows you. The chart shows you how for years, under our voluntary compliance system, we've reported income tax returns, gift tax returns, estate tax returns when people die, bank deposit returns, forms informing us from our employers and people who pay us interest and dividends, all to the U.S. voluntarily. And a lot of those institutions that have paid us and employers who have paid us have also filed voluntarily all of those forms. Now you'll see on this chart all of the new forms that have come into effect and are going to be effective very shortly. The new U.S. voluntary disclosure laws that require you to report all of your foreign financial assets. Anything that produces income needs to be in a information return. That was the first addition to kind of closing the trap on the U.S. taxpayer. And that's effective as of the year 2011. So taxpayers for 2012, in 2012 now, need to know that that form needs to be filed. What has really snuck up on everybody is the second set of new laws under this particular reporting system, and that is that foreign financial institutions are, by the end of the year 2013, going to close the rest of the trap. We're going to talk about this. America has awoken to the global world. And when I say that, I mean the American tax collector has woken to the global world. And they are now putting their arms around the global world. And all that it means by way of increased tax collection and increased enforcement. That's what we're going to learn about here. By the end of the year 2013, the trap is pretty much going to be closed. We're going to look at all parts of the trap, and we're going to look at the amnesty, the provisions by which the IRS is going to allow people with unreported foreign and, to some extent, domestic financial income and assets to have those things reported properly and to have prior taxes paid properly without running into the major problems that can happen as an alternative to doing it the right way. The first thing I'm going to get into is the amnesty that the IRS has granted. This is the first time that the IRS has granted an open-ended amnesty on tax payments resulting to offshore deposits. And also, it appears to me from the some of the publications, that it's also the first time that the IRS is starting to look into tangible assets, foreign tangible assets, and reporting of those foreign tangible assets when they haven't been acquired with after-tax money. But anyway, there's a new amnesty. It has no end date to it. The amnesty permits people who have foreign bank deposits and foreign assets, tangible assets that have been acquired without the proper payment of U.S. taxes on the money that acquired them, can come forth and report this situation now and avoid any criminal penalties that may be out there if all of this is discovered in an audit or by virtue of a whistleblower lawsuit or whatever other means are at IRS's disposal. The amnesty program is it's an expensive program, so that has to be kept in mind. But what it does provide is it provides the taxpayer with sure knowledge of where things are going. All of the following penalties that I'll go through quickly, there's a host of civil penalties. Many people are familiar already with the penalties that go with not reporting your foreign bank deposits. Over $10,000 can be exceedingly high, even to the point of being 50% of the actual bank balance under certain circumstances. There's a penalty for the failure to file a return if one has gotten a large gift or if one has gotten a large payment from a foreign trust. These can be as high as 25% of those payments. There's a penalty for United States persons who are officers, directors, shareholders in certain foreign corporations and don't report that. And penalties for U.S. persons that don't report ownership in partnerships. There are civil fraud penalties also. These penalties can be almost as high as the tax that's been avoided. There's a fraud penalty for failing to file a tax return that can be as high as 75% of the unreported taxes. A fraud penalty for failing to pay the amount shown on the return. And then there's an accuracy-related penalty for the amount of taxes not paid that can be as high as 40% of the unpaid tax. The criminal penalties that someone is avoiding is prison terms up to 5 years for tax evasion, and it goes on. That's what one doesn't have to deal with. The cost of the amnesty is to go back a maximum of 8 years. If your bank deposit or your holdings you've only had them for 4 years, you don't go back 8 years. But you can go back a maximum of 8 years to report your income, proper income, from the foreign assets, the foreign bank deposits, and certain other assets. On that income, which you will report the proper tax, there'll be a 20% accuracy penalty. In addition to the accuracy penalty, there'll be a payment of interest in line with what the Internal Revenue Code provides. That will be different over all of the last 8 years. The interest payment very much will track the Treasury index, and then there will be the overall penalty that is asserted in lieu of all the other penalties, which is an amount of 27.5% of the highest amount in the taxpayer's total amount of bank deposits in any given year. So if over a period of 10 years you have an account of $100,000 in 9 of those years and $120,000 in 1 of those years, your penalty is asserted on the $120,000. It's a penalty of 27.5%. Along with the penalty is a need to give complete cooperation to IRS on who you've dealt with this, that, and the other, because they are actually just ever increasing their web from the information that they get from the full disclosure people. Just as a sidelight, there's an interesting issue for people who have funds in certain kinds of foreign investment funds that hold shares of other companies that lead to even additional taxes that have to be taken into account. It involves a special kind of company called passive foreign investment companies. Anyway, who is eligible for this? The main criteria for being eligible, in addition to being a U.S. taxpayer, which includes entities such as corporations, trusts, partnerships, is that there is no IRS civil examination going on at the time that you're making the disclosure. And certainly, if there's a criminal IRS investigation going on at that time, the person isn't eligible. IRS does have a procedure that sometimes makes sense, where one can actually submit a name to the Internal Revenue Service for pre-clearance as to whether you're on their radar screen, and they will let you know. So I guess at least you will be able to protect your Fifth Amendment rights. Once the returns are filed, they should include payment. If the taxpayer is unable to make payment in full, that will go through the normal IRS procedures, and you're going to need to provide for any typical offer in compromise or settlement agreement, full financial disclosure to the IRS to proceed on that. What has to be filed as part of your submission is the following. All of the previous filed returns plus amended returns for all the years. A complete foreign account or asset statement for the FBAR, as everyone knows it, for foreign bank deposits. And also for this other class of foreign assets, disclosures relating to tangible assets not acquired with after-tax money, a statement of that, a check payable to the Department of the Treasury for the amount of the tax, the penalty on the bank deposit, the interest, and the accuracy penalty. Individuals whose accounts are more than $1 million need to also file a statement on the financial institution that they have their account in, with some disclosures on who they dealt with, what have you. For those people who have 500,000 or more, they need to have, as proof of this, the copies of their offshore financial account. And there'll also be a need to agree to extend the statute of limitations for the IRS to go through the procedures on this if necessary. Finally, I want to just kind of read from the IRS's writings on this last idea dealing with the tangibles. And it reads as follows. The penalty applies to all assets directly owned by the taxpayer including financial accounts holding cash, securities or other custodial assets, tangible assets such as real estate or art, and intangible assets such as patents or stock or other investments in a U.S. or foreign business, if the assets were acquired with funds that evaded the payment of U.S. taxes. Whether such assets are indirectly held or controlled by the taxpayer through an entity or alter ego, the penalty may be applied to the taxpayer's interest in the entity if the service determines the entity is an alter ego or nominee to the taxpayer's interest in the underlying assets. Now, the other thing that they make firm about the voluntary compliance program is that there's really no deviation from it. There isn't a lot of room for hardship. There isn't a lot of room for inequalities to be pled. There's very, very little discretion in this. Now, the taxpayers can take an appeal. Also, under another interesting twist, the IRS will, under no circumstances, collect a higher penalty than if, under all of the other rules, the penalty would be lower. And they give some very good examples of it. I want to make you aware of the best guidance that one can get on this while we're talking about this. If you go to irs.gov, they publish a list of questions. Those questions deal with the amnesty program. They'll be very helpful. There are two places where the bank deposit penalty will be lowered. There is a 5% penalty, and that pretty much applies to someone who knew there was an account, never really did much with it at all, and certainly never benefited in any significant way from it. The 5% is that they didn't cause the account to be opened. They had infrequent contact with the account, and they have, except for when they closed the account to move it to the United States, withdrawn more than $1,000 in any year. And they can establish that all applicable U.S. taxes have been paid on funds deposited to the account. There is also a de minimis 12.5% penalty, where 12.5% will apply only on where the highest aggregate balance in the highest year was less than $75,000. I know I did say that the service position on the amnesty was very much unmovable. However, I do want to report that we're having success in certain types of cases in getting the bank deposit penalties either eliminated or reduced in a manner which doesn't show up obviously in the IRS series of questions. In the first case, we're relying on question 17 in the IRS question, which does say if you have no taxable income and you've paid all your taxes on your taxable income, there's not going to be the substantial FBAR penalty violation that comes with a willful FBAR violation. And that being the case, with no taxes due, you don't need to be in the amnesty program. Now, what we have found is people have gone into the amnesty program, and then because of either loss carry forwards or foreign tax credits on foreign income, or whatever may arise in these individual situations, that at times, even though there's been foreign bank deposit investment income not reported, we have been able to show that there has been no taxable income. So that's one area where there is some deviation if it's handled in a sophisticated way. The other thing that fits into that same category is question 50. Question 50 in the IRS questionnaire makes it clear that the large bank deposit penalty of 27.5% is really a substitute for the FBAR penalty for those who have never filed the FBARs during all those prior years and the unreported years. Now, the FBAR penalty, as we discussed, is the penalty the IRS uses as the club to say we can get 50% of your bank deposit every year for every year you didn't do it if you were in willful violation, knowingly, willfully violated and failed to file your FBAR returns, your information returns that disclosed your income, your bank deposit taxable income. However, what the IRS says at question 50 is the failure to file your FBAR returns, your bank deposit returns, and even to report your bank deposit income may really not be so willful, so heinous, that it deserves such a high penalty. And the IRS has recognized that in the regulations that govern the FBAR. So what IRS says at question 50 is, since the bank deposit penalty is really a substitute for the FBAR penalty, if your failure to file your bank returns, the FBAR, which is the FBAR penalty, if they were not willful, then we're going to give you a reduced penalty, and we're not going to charge you as much. In other words, we're not going to force you to pay a bank deposit penalty when, had you come in under old law, you really wouldn't have had to pay such a high bank deposit penalty to begin with. We've had success in that area too, at looking carefully at whether there has been a willful violation in the past of the failure to file the FBAR. So that really is, I'm just going to put a plug in for professionalism here, because we take a very, very careful look at everyone who joins the amnesty program, not just to provide a really excellent professional product, which is the key to the amnesty program, but also it's important to know that we take a look to make sure that we're not paying more than any taxpayer should be paying under the amnesty program. We're now going to talk about the new law that requires the filing of an information return with an American taxpayer's 1040, or if you're a corporation, 1120, if you're a trust and estate, 1041, whatever the proper income tax return is. There's a new information return that's going to be required for specified persons that hold specified foreign financial assets. This reporting requirement goes much further than the FBAR that everyone, the foreign bank deposit reporting requirements that a lot of people are familiar with. This is a new reporting requirement that goes to individually owned stocks, all types of assets that we'll explore here. There's a lot of new definitions that come into this new law. The first one is, what is a specified foreign financial asset? It's defined as any financial account maintained by a foreign financial institution, any stock or security issued by any person other than a United States person, any financial instrument or contract held for investment that has an issuer or counterparty that is not a United States person, and any interest in any foreign entity. Who's a specified person? An individual who is a U.S. citizen, a resident, or a non-resident who elects to be taxed as a resident, and U.S. entities filing returns. The owner of a disregarded entity, such as a limited liability company, is treated as an individual for purposes of this reporting requirement. What is an interest in a specified foreign financial asset? That's defined. A specified person has an interest in a specified foreign financial asset if any income, losses, gains, deductions, credits, gross proceeds, or distributions attributable to the holding or disposition of the specified foreign financial assets are or would be required to be reported, included, or otherwise reflected in by the specified person on an annual return. Pretty broad. Now, there's some minimum reporting requirements. Basically, you will not have to file this new informational return if, as a single person living in the U.S., at the end of the year, your asset is worth less than $50,000, and at any time during the year, it was worth no more than $75,000. Married taxpayers are just double it, $100,000 on a joint return for foreign financial assets on the last day of the year, and $150,000 for the minimum to have to report on the value that those assets have gone up during the year. Taxpayers living abroad have a much more liberal standard, as could be expected, because they're going to have foreign bank accounts. An individual living in a foreign country who is a resident there will not have to file any of these information returns if their foreign assets do not exceed $200,000. And for a married couple, it would be $400,000. The value also must not exceed more than $300,000 at any time during the year, and for married couples, no more than $600,000 during the year. There are penalties for not filing this information return. We need more definition in order to see exactly what type of accounts need to be reported. Any financial account maintained by a foreign financial institution has to be reported. That's defined as a financial institution that takes depository accounts, custodial accounts, or any debt or equity interest in those financial institutions. Other financial assets that need to be reported: stock issued by a foreign corporation, a capital or profits interest in a foreign corporation, a note, bond, debenture, or any other indebtedness issued by a foreign person, an interest in a foreign trust or a foreign estate, And any kinds of financial derivatives that involve ownership of these types of assets. The law is not aimed at the business people who are dealing in these on a day-to-day basis because it would make it impossible to deal. The law is really aimed at the investment side of things. So there are several exclusions. There's an exclusion for traders. There's an exclusion for any foreign assets that are used in a company's trade or business. And there's an exclusion for any interest that one has in foreign pension and state plans like our Social Security plan. There are a few places where foreign disclosure form will not have to be filed because the taxpayer has filed a similar U.S. form disclosing whatever would have been necessary on the foreign disclosure form, the Form 8938. And this is such things as if foreign corporations that are controlled foreign corporations, the 5471s that are filed on behalf of those type of entities, the Form 3520, which discloses the foreign gifts, several other forms that, if they're filed, this disclosure form we've been reviewing, it does not have to be filed. The following is a list of the requirements of disclosure for each of the various types of assets. I also want to highly recommend, while we're discussing this, the Internal Revenue Service instruction form for this Form 8938, as it's done, I think, a very good job of dealing with a reasonably complex subject. Anyway, the required information is as follows. Stocks and securities. The name and address of the issuer must be supplied. The information that identifies the class or issue of which the stock or security is a part. Financial instruments. Any financial instrument or contract held for investment requires information that identifies the financial instrument or contract, includes the name and addresses of all issuers and all counterparts. Foreign entities, information that identifies the interest in the foreign entity and the name and address of the entity. Custodial accounts, whether a custodial account was open or closed during the year, information should be filed. All information regarding income from any of these assets also needs to be included. Before we get into the details of this foreign financial institution reporting, I want to describe in summary exactly what's going on and the newest development, which is the development of the United States entering into treaties that are involved in this new reporting system. In summary, the foreign financial institution reporting requires foreign financial institutions and foreign non-financial companies that are owned by U.S. people that have a certain amount of equity in those foreign companies to report as follows. All foreign financial institutions are going to have to ultimately report on almost every type of United States taxpayer account that is held in any of their institutions, whether it's bank deposits, whether it's shares, whether it's whatever it is. The foreign financial institutions are going to have to report all of the U.S. accounts in those foreign financial institutions and account for them. And if there's not a treaty in force that we're going to discuss, and if there is a failure to report that properly, foreign financial institutions that take in U.S. money and don't report it properly may have to actually pay a U.S. tax on that money to the United States. That's the bottom line of this. Now, what has developed is that the foreign financial secrecy laws have forced a lot of the foreign financial institutions to be fearful of the new U.S. laws because they might be sued for reporting American accounts and be in violation of secrecy acts of their own countries. So the U.S. has very recently, in order to make that be a non-issue, has entered into a model treaty that's going to become a treaty very quickly in a lot of the Western European countries and Great Britain. And under those treaties, foreign financial institutions are not going to have to report to the Internal Revenue Service of America anymore. But financial institutions in those treaty countries are going to have to report information on all of their American accounts to their own countries' government institution that will handle this, their equivalent of the U.S. Treasury, and then on a government-to-government basis under these treaties, the information will then be passed from, let's say, the German government to the American government, and then down to the Internal Revenue Service by the American government instead of directly by the foreign financial institution. There's a comparison to be made for several of you who do work in this field and are used to the typical reporting requirements as a withholding agent. If you're paying interest or dividends or rental income sometimes, or certain payments, royalties, you're familiar with the fact that there's a procedure that you need to go through so that you don't become a withholding agent and responsible for the payment of that foreign person's tax. This is the new wrinkle that the new law has added, where you used to be keeping your eyes open for the foreign person and making sure that the foreign person gave you all the information that you needed to make sure you didn't pay that foreign person's tax. Now you have to pay attention not only to the foreign person, but you better pay attention to the American person who you're paying taxes to, or you're paying interest income to, or dividend income to. And now, when it comes to Americans, it's even worse, because with foreigners, you never typically had to withhold any tax on capital gains they made here in the U.S. However, under the new law, if an American makes capital gains and he makes it indirectly because he's got a foreign bank account or a foreign corporation, that capital gains, whoever's paid that gain to that foreign corporation could be a withholding agent also. So the broad overview of what the new law has done is it has made withholding agents of American payors of several types of investment income if they know that they're paying it to foreigners and or foreign bank accounts. They can deal with this through a procedure, however, that the Internal Revenue Service has provided to make life easy for everybody. I'm going to explain what that procedure is after I go into a little more detail on some of the intricacies of this new law. I don't want us to get our eyes off the fact that what this is trying to do, that this new law overall is trying to do, is to make sure that every foreign financial institution that is handling dollars of an American or certain items of value of an American, together with all the U.S. financial institutions, that when all of that information is put together, essentially there should be one single place for someone to push a button and know what you're worth and what your income is and why it is. What is this new law? How is it being accomplished? How is it being fulfilled? What the United States has provided for, and the bottom line of all this, is that so long as the foreign financial institutions of the world will enter into an agreement with the Treasury that they will keep account of all American accounts, will seek them out, will scour their records, will do it on a regular basis, and will report all of their American accounts. Basically, there's not going to be any issues for the person who's making, the American person who's making the payment to that foreign financial institution, because that foreign financial institution has already made an agreement with the United States, and the United States is satisfied either that the American is reporting that interest payment on his tax return based on the form that you sent, all right, or the foreign financial institution is holding back 30% on the payment of that money and paying it over to the United States. With that, the American payor has really shifted any obligation they may have to the foreign financial institute, and the foreign financial institution is basically, should be already established to provide whatever proofs are necessary to the American payor. And that's because they're already working with the U.S. Treasury Department to provide all information that they have whatsoever on any American accounts that they have. So that's the very bottom line of what this new law does. The way to approach it, and I believe get a little more knowledge from it, is it has a good deal of regulations, and these regulations all use a whole new glossary of terms that take some old tax terms and mix them with new tax terms, and it makes it difficult to really put together what are you after, what is the bottom line, what do I have to do to make sure there are no issues here. It makes it a little difficult to do that in the way in which it's written. So I like to start by taking the definitions that they've made up, and going through each definition, so we'll have a little knowledge of what we're talking about when we summarize this. The first definition is what they term, what is a withholdable payment? That's telling you the type of income that has to be withheld on, the investment type of income that has to be withheld on, together with wages also, for people who have worked here in the U.S. and made wages and then left and they're not U.S. citizens. So withholdable payments are wages, salaries, rents, basically passive types of income. Now, in addition, a withholdable payment for these new laws is any gross proceeds from the sale of property that's paid to a foreign financial institution for an account that really is on behalf of an American. Right? So those are the kind of payments that there's a withholding obligation on, and that everyone really up the line needs to get a bit of clearance through the right forms. So that's the first definition, the withholdable type of payment. The next one is what's considered to be a U.S. account that the foreign institution has to be looking for an account for. A U.S. account is any financial account maintained by a financial institution that is held by one or more U.S. taxpayers, essentially, U.S. citizens and tax residents, U.S. entities, foreign entities that have become tax residents of the United States. An account is generally considered to be held by the person listed or identified as the holder of such account with the financial institution. And then they go on to provide what do you do in the case of a trust, what have you. So a U.S. account is owned by any kind of U.S. taxpayer, basically. Financial account. There you can see it's very broad. It's very broad. It's any accounts, any kind of investment accounts, and individual shares, collective shares, pretty much, you name it, including insurance policies that have buildups in them, but not term policies. The next definition is they define debt and equity for purposes of these holdings. And there's another definition that we will get to a little later, where once we finish discussing the financial institutions and how they have to report, we're going to report on another set of entities that have to report under this new law. But the financial institution, as you can see, the definition there is very, very broad. And it is investment income. It is not aimed at money that is crossing borders in a trade or business, and payment of goods, doing business, or anything like that. This is really investment money. There are several types of foreign institutions that are going to be excluded, and you won't have to, you can make payments to them without really needing any kind of paperwork. And that comes under this definition of excluded foreign entities. You can see here that these are certain startup companies, certain non-financial holding companies. The next definition we come to is the recalcitrant account holder. And that's really the account holder that after the foreign financial institution has gone through all of its records and combed through everything and proved to itself and to the United States if they have to, that they've only got X number of U.S. depositors, and here's their account numbers, and here's their tax arrangement, and here's what they do, and here's how the whatever. We come to the recalcitrant account holder, and that's going to be someone who is suspected to be U.S. or suspected or just not have their things in order. They're going to fall into that little pot, and there's going to be 30% withheld by a foreign financial institution on whatever's coming to you if you own a recalcitrant account. That's the way that works. Now, we talked about foreign financial institutions. I want to add that there's another class of intermediaries, let's say, that will be receiving payors or could be receiving payments on behalf of Americans. And these are not necessarily financial institutions. So there is also a category for non-financial foreign entities that also need to keep their eyes open and may have a withholding obligation. First, we have to go back to what would a substantial owner be in a corporation or a trust or what have you. And that's a U.S. taxpayer who owns 10% or more of a foreign company. If we've got a foreign company like that, and it's not a financial company, that is also going to have a withholding obligation when they pay interest, dividends, wages to an American and capital gains to an American under these new laws. A more than 10% U.S. shareholder. However, for that group of entities, they don't have to go through the extended kind of work that's going to be done to have a foreign financial institution agreement in place. They basically have to identify their U.S. substantial owners and send in notice, just notice under penalties of perjury, that they have none, or whoever is in there that is a substantial U.S. owner. And that's how records are going to be kept from that side of it. There's also several exclusions because, again, this is not intended to get in the way of business. It's not intended to get in the way of traders. It's really intended only to be dealing with investment income. So there's a lot of exceptions that would be dealt with there. Basically, this is what the foreign financial institution needs to do to be in compliance with the United States so that there's really no issues arise about withholding taxes or not reporting things properly or anything else like that. Because good procedures have been put in place. And this is apparently a very well thought through program that has been years in development and still is being developed. So the foreign financial institution really does need to understand the foreign financial institution agreement, understand how to be in compliance with it, how to report it to the United States, how to deal with American accounts. There's no reason to have to throw out American accounts because they're Americans. There's reason to put them in a different category, that's all. Once in that different category, they'll present you with the right papers, and if they don't present you with the right papers, you'll hold back 30% before you pay their income to them. It's going to be that simple. And so there's procedures, there's very good guidance on how the procedures need to be followed, and what procedures need to be followed, and procedures on how to expand for an institution to make sure that all of its branches are covered without going to extra work. Like I say, a well-thought-through law that makes all the sense in the world to comply with will save enormous amount of wasted legal and accounting time if they're complied with. But at the same time, as we've talked about all through, the United States of America will soon know everything you own, where you own it, what kind of income it's producing. And probably all they need is Google to find out exactly where you spend it all. It's wake-up time for several different groups that I hope will be able to benefit from this.